Hey there, folks! Tonight, we're diving headfirst into the exhilarating, terrifying, and often confusing world of money markets. Now, I know what you're thinking. John, money markets? Sounds about as exciting as watching paint dry, but trust me on this one. Understanding this stuff is like having a secret decoder ring for the global economy. So, what exactly are money markets? In the simplest terms, it's where governments, banks, and big institutions go to borrow and lend money. Think of it like a giant high-stakes game of lending a friend 20 bucks, except instead of 20 bucks, we're talking trillions of dollars. And instead of your buddy promising to pay you back after payday, we're talking about complex financial instruments with names that would make your head spin. But here's the thing, these markets don't just impact the bigwigs in suits. They influence everything from the interest rates you get on your savings account to the price of your morning coffee. Yeah, it's all connected, folks. Buckle up, it's going to be a wild ride. Now, let's talk about the stars of the show, the assets traded in money markets. These aren't your typical stocks and bonds, mind you. We're talking about short-term debt securities, the financial world's equivalent of a quick loan. First up, we've got treasury bills, or T-bills, as the cool kids call them. These are basically IOUs from the government, promising to pay you back with a little interest in a few weeks or months. Then there's commercial paper, which is like the corporate cousin of T-bills. Big companies issue these to raise quick cash for things like payroll or inventory. We've also got certificates of deposit, CDs, which you might be familiar with from your local bank. And let's not forget about repurchase agreements, affectionately known as repos, which are essentially short-term loans backed by, you guessed it, securities. Confused yet? Don't worry, it's all perfectly normal. Just remember, these assets are all about short-term borrowing and lending, and they play a crucial role in keeping the global financial system afloat. Okay, so we've covered the basics of money markets, but how does all this translate into actual wealth? Well, it all boils down to one simple concept: investment. You see, money sitting in your sock drawer isn't doing you any good. To build wealth, you need your money to make more money, and that's where investing comes in. Now, investing in money market instruments might not make you an overnight millionaire, like playing the lottery. Though, let's be honest, what are the chances of that? But it can provide a relatively safe and stable way to grow your money over time. Think of it like planting a tree. You're not going to get a bushel of apples overnight, but with patience and a little nurturing, you'll eventually reap the rewards. Of course, investing always involves some level of risk, but by understanding the different asset classes, diversifying your portfolio, and seeking advice from a financial advisor, no, seriously, don't just trust some random guy on the internet. You can minimize your risk and maximize your potential for building wealth. Now, you might be thinking, if governments need money, why don't they just print more of it? Sounds like a simple solution, right? Well, not so fast. You see, printing more money doesn't magically create more wealth. In fact, it can actually lead to something called inflation, where the value of each dollar decreases. Think of it like this. Imagine if everyone suddenly had twice as much money. They'd all rush out to buy the same things, driving up demand and, you guessed it, prices. Suddenly, that cup of coffee you used to buy for $1 now costs $2. Your money hasn't disappeared, but it buys you less. So while printing more money might seem like a quick fix, it's a bit more complicated than that. It's a delicate balancing act, and governments need to carefully manage their monetary policy to avoid throwing the entire economy out of whack. Section 5. Follow the money, a journey through the financial system. Okay, let's take a step back and look at the bigger picture. Money, in its simplest form, is just a medium of exchange. It's how we assign value to goods and services and make transactions without resorting to bartering chickens for haircuts. Though that would be an interesting sight. But the flow of money is anything but simple. It's a complex web of transactions between individuals, businesses, banks, and governments. Think of it like a vast network of pipes, with money flowing through it like water. Banks play a crucial role in this system, acting as intermediaries between borrowers and lenders. They take in deposits from savers and then lend that money out to businesses and individuals who need it. Central banks, like the Federal Reserve in the US, Act as the banker's bank, setting interest rates and controlling the money supply to keep the whole system stable. Understanding this flow of money is key to understanding how the global economy works. It's all interconnected, folks. What happens in one part of the system can have ripple effects throughout the entire world. Section 6. Currency exchange and overnight investments. Making money while you sleep, maybe. Now, let's talk about a couple of specific aspects of the money market that might seem a bit mysterious. Currency exchange and overnight investments. Currency exchange is pretty self-explanatory. It's simply the process of converting one currency into another. Say you're traveling to Europe and need to exchange your US dollars for euros. You'll go to a currency exchange and they'll give you the current exchange rate, which fluctuates constantly based on a whole bunch of economic factors. Overnight investments, on the other hand, are a bit more complex. These are short-term investments that mature within one business day. Banks and other financial institutions use them to manage their short-term cash flow, earning a small return on their excess cash overnight. Think of it like putting your money to work while you sleep, hopefully earning you a few extra bucks in the process. Section 7. Numbers don't lie. A glimpse into market data. Hold on to your hats, folks, because things are about to get a little number heavy. But don't worry, we'll keep it as painless as possible. The global money market is massive, with trillions of dollars changing hands every day. To give you a sense of scale, the US stock market alone is worth over $40 trillion. That's a lot of zeros. The commodity market, where raw materials like oil, gold, and wheat are traded, is equally huge. Fluctuations in commodity prices can have a major impact on everything from the cost of gasoline to the price of bread. And then there's the cryptocurrency market, the new kid on the block. Bitcoin, Ethereum, Dogecoin. These digital currencies have been making headlines in recent years, with their values soaring and crashing with dizzying speed. The real estate market is another behemoth, with residential and commercial properties representing a significant portion of global wealth. Factors like interest rates, population growth, and economic conditions can all impact real estate prices. Section 8. The global players, who's pulling the strings. Now, you might be wondering who's calling the shots in this global financial system. Well, it's not just one person or entity. It's a complex interplay of governments, central banks, financial institutions, and individual investors. Certain countries, however, wield significant influence due to their economic power and the size of their financial markets. The United States, with its massive economy and the US dollar's status as the world's reserve currency, is undoubtedly a major player. China, with its rapidly growing economy, is also becoming increasingly influential. The European Union, Japan, and other developed economies also play significant roles in shaping the global financial landscape. It's important to remember that this is a constantly evolving system. New players emerge, old ones adapt, and the balance of power shifts over time. Section 9. Bringing it home. Why should we care? Okay, so we've covered a lot of ground tonight, but you might still be wondering, why should I care about all this? I'm not a banker or a Wall Street tycoon. Well, here's the thing. Even if you never buy a single share of stock or invest in a money market fund, the global financial system impacts your life in countless ways. Remember those interest rates we talked about earlier? They determine how much interest you earn on your savings account and how much you pay on your mortgage or car loan. The strength of the US dollar affects the price of imported goods, from electronics to clothing. And let's not forget about the job market. A healthy financial system is essential for economic growth, which creates jobs and opportunities for everyone. So, while the world of money markets might seem complex and intimidating, it's in our best interest to understand at least the basics. After all, knowledge is power, and the more we know about how the system works, the better equipped we are to navigate it and make informed financial decisions. Section 10. The bottom line. Money makes the world go round. Well, folks, there you have it. A crash course in the wild and wonderful world of money markets. We've covered a lot of ground, from the basics of asset classes to the complexities of currency exchange and the flow of money. The key takeaway here is that money, while just a tool, is a powerful one. It can be a force for good, driving innovation, creating jobs, and improving lives. But it can also be mismanaged, leading to inequality, instability, and economic hardship. Ultimately, the responsibility lies with all of us to educate ourselves about the financial system, hold our leaders accountable, and advocate for policies that promote a more just and equitable distribution of wealth. Because at the end of the day, money might make the world go round, but it's up to us to decide in which direction.